Well, students, now we'll come to the next important hidden adjustment, which is on insurance premium. Well, we'll take one trial balance as on 31st March 20. In trial balance, they've given insurance premium, debit side 6,000. In bracket, they've given out of which rupees 3,600 was paid for the year end 30 June 20. Now, in current year, students, total insurance premium we have paid 6,000. But they have given in bracket that out of this 6,000, we have paid one premium of rupees 3,600, but that year ends on 30 June 20. So out of this 3,600, we have made a prepayment for 3 months. Well, 3 months, that is our year ends on 31st March 20. But we have paid up to 30 June 20. So 3 months prepayment we have done, but out of which amount? 3,600. So if we calculate the prepaid insurance premium amount, that is 3,600 into 3 by 12. The amount of prepaid insurance will be 900 rupees. So this adjustment becomes adjustment of prepaid insurance premium rupees 900. Now, if we see the effects of this adjustment, we'll take profit and loss account and balance sheet. We'll first post insurance premium in profit and loss account debit side, inner column 6,000. Now if we take this adjustment effects, the first effect from insurance on P&L debit side will deduct prepaid insurance 900 and outer column will record 5,100. The second effect will show prepaid insurance as our current asset on balance sheet asset side. Well, now we'll take the second variation of this adjustment. They can ask this adjustment separately, guys. Well, again we'll take one trial balance. In trial balance, they've given insurance premium 6,000 debit side. Below insurance premium in bracket, they've given paid for the year ended 30 June 20. Well, if you compare early year adjustment, in trial balance, again insurance premium was 6,000, but in bracket they had mentioned out of which rupees 3,600 was paid for the year 30 June 20. Here instead, directly they have given was paid for the year ended 30 June 20. That means 6,000 is paid for the year ended 30 June 20, guys. So our year ends on 31st March 20, whereas we have paid up to 30 June 20. So we have made a prepayment of 3 months, but this prepayment we have done out of 6,000 rupees. So if we calculate the amount of prepaid insurance, 6,000 into 3 by 12, that comes to 1,500 rupees. Now, if we see the effects, we'll take profit and loss account and balance sheet. In profit and loss account, insurance premium, inner column we will post 6,000 minus prepaid insurance premium 1,500, outer column 4,500, and this prepaid insurance 1,500 will show as our current asset in balance sheet asset side. Dear students, now we'll come to the last most important adjustment, which is on bad debts and bad debts reserve. We'll take one trial balance as on 31st March 20. In trial balance debit side, they have given debtors 50,500, bad debts debit side 1,000, and bad debts reserve given in trial balance credit side 1,500. Well, adjustments. The first adjustment, there were additional bad debts of rupees 500, and the second adjustment provide 10% for bad debts reserve. Well, if we understand trial balance items, in trial balance they've given bad debts 1,000. That means This is a recorded loss. Well, bad debts is the amount which the customer has not paid. It is our loss. Well, bad debts reserve given in trial balance. First, let us understand what is bad debts reserve. A reserve which is created to cover the loss of bad debts is known as bad debts reserve. Well, the reserve which is given in trial balance, bad debts reserve, is last year's excess reserve, and that is the reason it is given in trial balance credit side. We treat as if it is our income. Well, in adjustment they have given there were additional bad debts of rupees 500. So these bad debts are new bad debts which still we have not recorded. And the second adjustment says that provide 10% reserve for bad debts. So the reserve which is given in adjustment is current year's new reserve which we have to create. So if we sum up, the bad debts which are given in trial balance, they are already recorded. It's a recorded loss. Bad debts reserve given in trial balance is last year's excess reserve. Bad debts given as adjustments, they are new bad debts yet to be recorded, and BDR given in adjustment is a new reserve which we have to create. Well, if we see the effects of this adjustment, we'll take profit and loss account and balance sheet. First, we'll post all trial balance items. Debtors will take in balance sheet asset side as current asset, inner column. Bad debts given in trial balance will record in profit and loss account, debit side. Bad debts reserve given in trial balance will record in profit and loss account, credit side. As I told, it is last year's excess reserve, so that becomes income in current year, profit and loss account, credit side. Well, now if we take the effects of adjustments, the first adjustment, there are additional bad debts of 500. These are new bad debts which we have to record. The first effect, from debtors in current assets, will deduct 500 rupees. Debtors are 50,500 minus bad debts adjustment 500. Inner column will record 50,000. The second effect of new bad debts will give in profit and loss account, debit side, as it is our additional loss, to bad debts adjustment 500. The next adjustment, if we take, provide 10% bad debts reserve. Balance sheet asset side, from debtors we have deducted additional bad debts, 50,500 minus 500. 50,000 is the net answer. Now on this 50,000, we'll create bad debts reserve 10%. So first effect, from debtors minus bad debts, again we will deduct bad debts reserve adjustment 10%. So 5,000, and outer column will record 45,000. The second effect of bad debts reserve adjustment will be profit and loss account, debit side, to bad debts reserve adjustment 5,000. Now students, the year in which you create bad debts reserve, in that year it becomes an expense, and hence it is debited in profit and loss account. So bad debts reserve given in trial balance is on credit side and is posted in profit and loss account, credit side, whereas bad debts reserve given in adjustment, it becomes an expense of current year, so it gets debited in profit and loss account, debit side, to bad debts reserve adjustment. Now if you refer your profit and loss account, it will appear like on debit side, 2 bad debts, trial balance 1000, 2 bad debts, adjustment 500, 2 bad debts reserve adjustment 5000, and on credit side, by bad debts reserve trial balance 1500. Now instead of showing this bad debts reserve separately, debit and credit side, there is another way where we can show these items in a table which is known as TAT table. T-A-A-T table. TAT table. Well, if we understand this TAT table, if we prepare TAT table with the same numerical, in profit and loss account debit side, 2 bad debts, trial balance 1000, plus bad debts adjustment 500, plus bad debts reserve adjustment 5000, total comes to 6500, minus bad debts reserve trial balance 1500. So outer column, the net answer of this table will be 5000. So this becomes TAAT TAT table. So instead of showing bad debts, trial balance, bad debts adjustment, BDR trial balance, BDR adjustment separately in profit and loss account, we can group them into one table, and that is TAT table. Now with the previous adjustment of bad debts reserve, we'll add one more adjustment, that is discount reserve on debtors. Well, first we'll understand the term discount reserve on debtors. Well,